everyone, GM. Welcome back to another episode of Overpriced JPEGs, live from New York. It is not Saturday night. I am here with Gabe Frank in person, here from NFT NYC. Gabe Frank is the founder and CEO of Arcade. And I was really interested in talking to Gabe today because Arcade is a lending platform. You can put your NFT up for collateral and get a loan off the back of that, which I think is really interesting right now in these bear market times to discuss. And I think financial primitives in the world of NFTs are really interesting, generally speaking. But Gabe has a particularly interesting background, which is he's worked at crypto companies for a while, BitGo, Curve. But prior to that comes from a family of pawn shop owners. And so is very well acquainted with the world of creating liquidity out of like physical non-fungible goods. So I think you have a special perspective to share here. And thank you so much for joining me, Gabe.
Sure. Thanks for having me.
So I want to start by just like painting a picture of how I think like an example of how Arcade works. So this is like how I picture the typical scenario going, and then you can correct me.
Sure.
So I have a CryptoPunk, and that's 100 ETH of mine that's just sitting there locked up that I can't really access because I don't want to sell my punk, but I'd love to have access to that 100 ETH. So I come to Arcade and I say, okay, I want a loan of 50 ETH and I'm going to like escrow this CryptoPunk. And so if I ever default on this loan, somebody else gets my CryptoPunk and I now get to go take this 50 ETH and put it into some yield farming protocol where I can earn some money back on it. And maybe I start paying off the interest of my loan that I just took out with that yield farming I'm doing. And isn't the world a lovely place? Is that like the typical use case for Arcade as it currently stands?
Yeah, so that's one strategy. I think that strategy is better fit for a bull market because in a bull market, you have APYs on these DeFi protocols that are higher than the interest rate on the loan would be. So an example is get a loan for 50 ETH on that asset. Say, average rates right now on our platform are like 18% APR. So borrowers just need to beat that APR to be able to make a profitable trade.
So let me just clarify that. So that basically the interest rate on that loan would be 18%.
Correct.
So they're paying 18% in interest rates. So they have to beat 18%. How many people got wrecked from Luna trading on your platform?
So no one from Luna because we're building on Ethereum. And
folks like swapping ETH that they'd taken out in loans for Luna to get that 20%?
No, I don't think we saw any of that. That probably did happen though. But I think our borrowers are a little bit more sophisticated and sort of DeFi power users. So when Luna was crashing, we didn't have any users take out loans for that use case.
Well, when it was crashing, I would hope they weren't taking out the loans.
Yeah.
I imagine they were taking out the loans before the crash.
Right, and they didn't buy the dip by taking out a loan, so
yeah.
That's a good thing. Yeah.
Other use cases, you seem to say like that's one strategy. What are some of the other use cases you see folks employing? Yeah,
so now that we're in a bear market, APYs have gone down. It's not a profitable trade to yield farm anymore, really. So other use cases are it's a hedge against your long position on your NFT. So taking out a NFT loan is like buying a put option because if the collateral value goes beneath the principal value, then the borrower doesn't have to come back to pay that loan. He can just let it go and buy the same asset for cheaper in the market. So in a way, it's like buying a put option. Another strategy is just levering up. So guys that have millions, sometimes 10, 20, 30 million locked up into NFTs, and they're somewhat sophisticated traders, DeFi power users, funds, DAOs that have treasuries, and they're investing the money elsewhere. So it's like opportunistic plays, maybe taking the loan, levering up on ETH or some other asset. And kind of the third use case is just people wanting to buy more NFTs. So typically, collectors have tons of NFTs. The value fluctuates quite a bit. So taking out a loan for capital efficiency, because it's just idle capital that's sitting there, that's locked up in the NFT, taking a loan and putting that money elsewhere, putting it to work and reinvesting in yourself. That's kind of the third use case we see.
So I want to talk about that second one where you described it as almost like buying a put option, like, going extra long on the NFT itself, you're saying?
So it's like going short the NFT.
Oh boy! All right. See, I'm gonna need just break this down, and if this seems like it's gonna bore the audience, we'll cut it out of the final cut. But so just walk it through me one more time, slower.
Yeah. So say you buy a punk that's worth 100 ETH.
Yep.
say you get a loan on that punk for 70 ETH.
Okay.
Now, in 3 months when the loan is due, if the value of the punk is now 60 ETH, why would you pay back the loan? Because the value of the collateral.
So the 70 ETH you got was even more than the what the punk itself is worth.
At the time the loan is due, correct.
Got it.
If the borrower, if that's the case, then the borrower doesn't really need to pick up the loan.
So the borrower will basically intentionally default, say, great, you can have this punk for 60 ETH, or for 70 ETH is what you've now paid for it. I can go buy a punk for 60 ETH, and I've now made a 10 ETH difference on that.
Yes.
Wow, that's really interesting. And now the lender's bummed about that dynamic, of course.
Well, the lenders are usually long these assets anyways, and I think if they can get an asset at any discount, they're going to take it. Some lenders have different profiles, so some may be long punks, some may be long BASI, some may be long Clone X. Just kind of depends on the lender profile. So yeah.
And in that example specifically, you mentioned like you got 70 ETH off of a punk that at one point had 100 ETH value, say. That loan to value ratio, that LTV, right, is you're looking at, you get 70 ETH off of a 100 ETH asset. That's high. Am I right? Like CryptoPunks, Bored Ape Yacht Club, some of these more liquid collections, you can get a bigger loan off of the asset than in other cases. Is that right? Speak to a little bit. What's like a typical?
That's correct. So like punks and BASI, they're more liquid. There's secondary bids. There's transaction history to price the asset. So lenders are more comfortable going a little higher on the loan to value ratio. Punks, we're seeing anywhere between 40 and up to sometimes 80% LTV. BASI sort of the same, but the average sweet spot's around 40%.
And who makes these determinations? Is it the person who's looking to borrow that goes on and sets the parameters of what they're hoping to get, and then a lender can come along and meet those parameters?
Yeah, it's a little bit of both. So a borrower can go and they can set their terms that they want in the marketplace on our DApp. And then a lender can come and choose to fund that loan based on those parameters that are signed on chain. A lender can also make a counter offer. So if he doesn't like those terms, he can make his own offer on that specific asset. And then the third way is we operate sort of this OTC white glove service where we work with high net worth counterparties that have high value assets, where we actually appraise the asset and value the asset and then match them with the lender. And then they meet on the DApp to escrow and settle the loan once all those terms are figured out.
So that's a more manual process, where if you have a fine art piece that's not highly liquid, but that is clearly worth a lot because it's a who did the currency, or Damien Hirst or a Fuocious or one of these pieces that can go for a lot. You'll kind of personally handle those cases in a more manual way.
Yeah, exactly. So it's like an OTC desk, but it's an agency desk. We don't make the loans. We're just the infra provider. So that's correct.
It's increasingly obvious that everything will become tokenized, and NFT marketplaces needs robust financial reporting, performance analysis, and the peace of mind that they are compliance ready. GILDED's NFT Ops is a one-stop financial reporting solution for growing NFT platforms. GILDED has developed marketplace-specific modules to track the financial performance of NFT creators, including revenue tracking, collection metrics, royalty payments, and revenue share. Customers of NFT Ops gain full access to accounting tools and powerful APIs for custom integrations that simplify operations, streamline reporting, and produce tax-ready data. So no wonder why so many top brands like CoinMarketCap, Gitcoin, Nifty's, and POAP trust GILDED to automate complex reporting workflows. Visit gilded.finance/bankless to learn more. RARIBLE is the NFT platform that's leading the charge into the multi-chain universe ahead of us. Available on Flow, Tezos, Polygon, and of course Ethereum, RARIBLE is the perfect place for NFT newcomers, profile picture collectors, and experienced NFT traders. RARIBLE has a variety of NFT features that set it apart from other NFT marketplaces. They have a native messaging function allowing you to DM your friends or haggle with sellers. They also have a mobile app on iOS and Android with a built-in NFT portfolio tracker tool, so you can easily check the value of your digital art portfolio. RARIBLE is built on the RARIBLE protocol, a multi-purpose, open source, and community-governed NFT protocol that helps build products and services across the NFT ecosystem, including white label marketplaces tailored to specific NFT communities. So go to rarible.com and start discovering and trading NFTs, putting in floor bids to join PFP communities, and DM with some brand new internet friends.
I want to get into how the bear market has affected things. You've already started alluding to some cases, but I want to talk about have defaults gone crazy? But before I get to that, I'd love to understand what's happening on the back end of these transactions from a technical perspective. I know you're taking these NFTs into escrow, but like, what does that actually look like on chain?
Yeah, so we built our own smart contract protocol. It's called the Pawn protocol. Ties into my background well. And basically the entire loan process and loan lifecycle is governed by our smart contracts. So the protocol is non-custodial. We don't take custody of the NFTs, nor do we have access to any of them. We also don't control the money movement. So when a loan is funded, it's all governed by the smart contracts.
One concern, let's call it, that I have about this concept of smart contract determined like outcomes, which on the whole I think is really exciting, and that's part of cutting out middlemen and all the rest of it, but is you lose that human touch. So we'll talk a little bit more about your pawn shop background and what you've learned from that, but it strikes me that like there's a little bit of humanity in there where like if I pawn my grandmother's ring and then I'm like, I need one more day to get you the money back so I can get my ring back, like I can go to you and plead my case. Whereas if something's being managed by a smart contract, it's very automatic and you lose that humanity. Are you finding that? How do you respond to that?
That's definitely true. I think like in a pawn shop, people are getting a loan on assets that mean something to them. Maybe it's a jewelry that was passed down by their family or something like that. Well, with NFTs, there's also like a mind, like a human connection, because a lot of these collectors, it's their online identity. So when they pawn those assets, or get a loan on those assets, they don't want to lose it. It's somewhat their online identity and how they interact. So there is a human element, though. Our OTC desk, the way the protocol works is that when a borrower doesn't pay back on time, the loan goes into default. So there's no auto liquidation. So when a loan goes into default, the lender has to manually claim the assets out of the protocol. Now, if the lender doesn't claim the assets out of the protocol, even after it's past due, the borrower can still pay off in a default status.
Is there a way for me, if I was a borrower, for example, and my asset or my loan goes into default, can I make contact with that lender in some capacity and say, hey, I need literally 2 more days. Please don't liquidate it and for the next 2 days?
That does happen. Borrowers and lenders are in contact with each other, usually in like a Telegram chat or Discord. But sometimes the counterparties don't know each other, and so that can't happen. But that's something we're addressing in our V2 protocol that makes it easy for different lenders to bid on collateral. So it's like a competitive bid market for lenders. And so borrowers will end up getting the best rate that they can.
You mentioned like at the end of the term, things going into default. Maybe let's just clarify for folks. My understanding is right now you almost exclusively work with term loans, right? So I want this loan for 3 months, and then at the end of that, I'm owed money, or I can roll over and keep the thing going if both parties agree. I'm assuming you can clarify that for me. But what we don't have is like a margin call situation where like if something goes below a certain, if the punk falls in price enough, I have to put up additional margin or capital. Do I have that right? Can you clarify for folks this term loan and what that really means?
Yeah, that's right. So there's no margin calls. There's no liquidation event. The loan just goes into default when at the end of the term. A borrower, though, if he doesn't have the full principal and interest, can roll the term over. So what we have in our V2 protocol is for different lenders to bid on rollovers. So when a loan is coming due, for a borrower, a lender can place a bid to extend the term. And so that's also a competitive bid market. So borrowers might be able to get better terms on a next rollover if a lender sees this wallet address is paid off before or is paying interest. So yeah, there's always this scenario of like perpetual borrow. You really don't ever have to pay your loan off in Arcade. You can continue paying the interest and extending the loan and keeping your money at work, which is a lot like how traditional art lending is done. Like people get loans against Picassos for $100 million at 2% from Bank of America, and then they reappraise the value of those assets every single year and take more money out. So I think we're going to see the same type of finance kind of play out in NFTs.
The big difference, it would seem, is that 2% to 18%,
that's the
right?
big difference, yeah.
If I have a Picasso and I can get a loan against it and the interest I have to pay back on that is 2%, it's, reasonable to beat 2%. 18% seems like it would be very hard to beat.
For sure. I mean, we are in a very risk-on asset class. I think there are plays that you can opportunistic plays, you can beat the rate. But yes, the profiles are a bit different here than trad art. Yeah.
In my final questions around just quite literally how does the platform work, How do you determine pricing, and how do you see price determinations maybe evolving over time?
Yeah, it's an interesting question. So we have a data science team, data engineering team that works on valuations and data and models for appraisals of the assets. There's no best way to value NFTs today. They're somewhat too illiquid. There are enough transactions on certain collections like Punks and Basie, but when you're pricing illiquid assets, it's tough. It's not a specific number that's important. It's more like a range. So people use floor price quite a bit to price NFTs and assets. We use a combination of a TWAP, a time weighted average, across similar assets in that collection. And so what we do at our OTC desk, we provide those valuations to our counterparties to help them come to terms on the DApp.
And so to give some examples, maybe this is obvious based on the conversation even up to this point, but it's some of like the blue chip collections. Maybe you can name some. You've mentioned Punks and Apes, but like Doodles, would they be in there? Like are Cool Cats in there? Like where do you kind of draw that line and make those determinations? And then is it like what we would consider almost like fine art pieces otherwise and one of ones? Or
Yeah,
does it go beyond that?
I think we're starting to see different sectors within NFTs emerge. There's the art space, there's the profile picture space, gaming assets, digital land. Each has their own different risk profile, and lenders will price them differently. So with illiquid things like the 101 art stuff, it's based on comps of similar works from that artist. With profile pictures, since there is somewhat a little bit of liquidity, you can base it off a weighted average. Right.
There was at one point liquidity.
Right. We lost a few bids this last week. But yeah, we think we have a good model to value the assets that help our lenders kind of make determination.
And you have things like gaming assets, it sounds like, then you're saying on there as well, or like land assets.
So gaming hasn't really taken off too well in Web3. I think you had Axie and Affinity. I don't know how well they're doing now, but
Gods Unchained, like you have a few, I think, that are
there's a few, and I think that'll get more relevant as there's games that people actually want to play, and not just like because they want to earn a token. But we're seeing a lot of profile picture avatars. So it's like CloneX, Doodles, Azukis, Punks, Basie. And then on the art side, it's creators like Fuocious, like Pack, Beeple. It really just depends on the lender's risk appetite, what he wants to lend against. That's really where the demand is.
Do you have minimums, like assets have to be worth at least a certain amount, or can somebody get a 1 ETH loan from Arcade?
No, I think our lowest loan has been half an ETH.
Wow, so it really is totally all purpose. I asked a little bit about where you think the future of this plays out, and that comes from, I interviewed Jake Bruckman, who's the CEO of Coin Fund, and I believe it was he who sort of said this to me, where he's like, just price discovery, like all of this stuff is going to be run by machines, like, and in some years' time, all of like the pricing mechanisms are going to be determined by like machines. Is that your view of this as somebody who's deeply involved in pricing assets in this space?
Yeah, I think Jake's right. I think we get to a point where it becomes so sophisticated, like the pricing is down to the exact trait. Until that matters, though, there is a human element because it's hard to price illiquid assets, so there has to be some discretion.
Okay, I'm going to preamble this question. One of my concerns around this stuff is leverage and the way we see that leverage makes the crash even harder. What's interesting about what I hear you saying is if we look at previous crashes like 2008, right? Part of the problem there was nobody knew how to price these like mortgage-backed securities, right? And it was like a tangled web of like, what the hell is any of this stuff even worth as things were crashing? Is there a world where that's actually better in this new digital future if we do have like total price history, transparency, everything's on chain, and we have machines that can tell you to instant what the price of these things are worth? Or am I naive?
That's probably a better world. I think anytime you have more liquid economies and assets, it makes everything move better. So access to credit is very important in any economy, and I think NFTs will capture quite a bit of value going forward, whether it's digital IP or art or profile pictures. But being able to take liquidity and get accurate pricing that lenders and borrowers feel comfortable with, that's important.
Like instant pricing across all assets is a fascinating concept.
Yes.
You think we'll get there?
I think we'll get there for digital, like native digital assets.
Sure.
Yeah.
Yeah. Very interesting. Okay. It's a bear market. It's totally changed the dynamics. Have you seen a big uptick in defaults since the bear market has hit?
So not yet, but I think in the next month or two, we're going to see quite a bit of defaults happening.
Interesting. And why is that? Just because it's the 3-month term time horizon is typical?
Right. So some loans we made 2 months ago, they're still waiting a month for the loan to come due. Also, what's interesting about these term loans is that like people don't want to lose these assets, even though the value goes down because of their social identity. So they will probably extend the loan until the market turns around, maybe. But that's the risk that they're going to have to take.
Do you feel any qualms about helping to put like excess, essentially leverage into the system, which again then make these crashes all the harder?
No, I think these things are going to get built. I think the infrastructure is going to get built. I think that we have the right DNA and background to build safe systems to do so.
Do you have like education pieces? What do you do to help folks really understand what they're getting into if they're maybe new to this kind of trading?
Yeah, so there are a ton of dashboards that you can utilize for like floor pricing and trait rarity and things like that. We developed our own community tool called metadata.xyz, which is basically just a floor price dashboard and trait rarity for the top 15 collections. So that's something we're releasing soon, kind of to enrich our users, to help them come to terms, make better financial decisions on the DApp.
And orient us. So when did you launch Arcade?
Launched Arcade in April 2021.
And I know you've got I was seeing like $5 million. I think it's probably different now of like trading volume, or give us orient us in terms of like how big this market is right now or has been.
Yeah, so we've done 25 million in loan volume, notional loan volume. Most of our loans are funded in WETH, wrapped ETH, or USDC, but total it's 25 million. I think NiftyFi has done now 200 million. So the entire market, you have also protocols like BendDAO and JPEG that have done some volume. So I'd put the size of the market in loan volume probably at 300 million today. Whereas I think the TAM of this market today is probably $500 million, just because the universe of NFTs and what NFTs are has to grow for the loan volume to pick up. But I'd put it at half a million, right? $500 million.
Do you happen to know what, and this is so hard to quantify, but like what like the pawn shop market is, or what some sort of equivalent? I don't think that's actually the right equivalent yet. And we'll get into that, but like what the equivalent IRL market is.
Yeah, so there's, I think, 3 public pawn shops right now. They probably all have a loan book of like 3 or 4 billion. And so they have 3 billion of loans on the street, possibly. And on that 3 billion, pawn shops earn a lot of it's high interest. So they're earning maybe 10% a month on that money. So yeah, I think the in real life non-fungible loan market is pretty big.
But pawn shops probably aren't the right comparison. I mean, I think that's an interesting background you come from, but it strikes me that you're dealing with like high net worth individuals or people with a decent amount of disposable income and maybe financial sophistication, certainly enough disposable income, or got lucky enough to find themselves with these like 6-figure, JPEGs. And pawn shops strike me as people who are on the lower income side and are pawning something not because they're going to yield farm and get a couple percentage interest points higher, but because they need to make rent next month.
Right.
Does that comparison seem
right? In the bear market, we're more like a pawn shop now.
Okay.
But yeah, I think these borrowers have disposable income. They can buy JPEGs. I do think though with this market, we will see different use cases of just people needing money to take out of the crypto ecosystem and into dollars. So I think we'll see different use cases like that.
What's like the most interesting? Because there's lots of people and they're just going and putting it in another protocol and like getting more interest on it and paying back the loan. Whatever. But like, are there some really like interesting use cases you've seen of people leveraging this to change their lives for the better?
Yeah, we had an interesting one last week with Mike Majlik. He's this, I didn't know Mike before. Now I know him, and he was buying a home in LA, I think for $4 million. He'd been looking for a house to buy in LA. His podcast, I think it's like 1 or 2 million views. So he's got some influence. And he reached out to us because he needed dollars in the bank for his down payment on that house. So he has a Bored Ape that he sent us the token ID. We valued it and then gave him terms on the asset. So we gave him a $200,000 USDC loan at 10% APR for 2 months. And basically what he's doing is he converted it to cash on Coinbase, and then he's using that money for a down payment on the house.
But then he has to pay you back in 2 months, but he can pay just the interest piece on that, is the idea?
Right. If he doesn't have the full principal, then he can just pay the interest back.
And then default on his ape?
No, like he probably has cash that's coming in the future, and so he didn't have the cash at the present moment.
So he's going to get paid in the next 2 months, 2 or 3 months, and so it's almost like just like a payday loan at that point to some extent, right? Like before my
I used to make
paycheck.
payday loans, so they're much higher interest. But
Does that feel predatory?
I didn't think so. I mean, people really need. It's like a last resort for people. They love when they get the loans because they need the money. They don't love when they need to pay it back. It's a different story, but yeah, payday loans are, I think, almost a necessary evil because people need access to credit in real life. And why not get a loan on an asset that's sitting in your home that's not doing anything for you? So
I'm fascinated by buy now, pay later because it's credit getting around all like the usual without like charging the consumer for using credit, right? They're charging the retailer because it'll get more people to buy into their goods, right? Like, how does that map to a digital economy world?
Yeah, so buy now, pay later is basically a loan. So it's in our wheelhouse of products that we can offer. So and the way buy now, pay later works is that these platforms offer the lenders rebates for actually providing the access to.
Well, let's spell this out because my understanding of buy now, pay later is if I'm Lululemon, I don't know, insert here, right? It's shown that somebody's more likely to spend money on my online shop if they have the buy now, pay later option because it makes it look cheaper to them and they feel like it's cheaper. So they're going to spend more money in their cart ultimately if I have buy now, pay later. So I pay a buy now, pay later company basically to integrate their tech in there because I'll make more money by charging consumers more. And then I, as a consumer, basically am able to pay it off over time, which is like credit, except that I'm not getting charged an interest rate on that.
Right.
Is that right? That's how it
right.
works?
Yeah, exactly.
So in this scenario, like you would be like a tech thing that the CryptoPunks marketplace could integrate onto their marketplace and maybe would pay you a cut. And I now can come on and buy a CryptoPunk, but pay it off over the course of 6 months.
That's correct. Yeah. So if we're not like if in buy now, pay later, if we're not charging the consumer interest, how does the lender get paid? Well, it's usually on rebates for more people using that platform. The companies find to give rebates to the lender.
So you still end up being the lender. Like buy now, pay later. It like that company is basically is fronting the money to Lululemon for the consumer.
That's correct. I'm not an expert on buy now, pay later. There's companies like Affirm and
they're not doing too well in this market either, I'm pretty sure. I think a lot of these
and now you have
pay
Apple that's going to do it themselves. But it is a loan. So
what are the regulations around this? Let's actually even just talk IRL about like payday loans to prevent people from just being like truly exploited when they're in a desperate situation. Are there regulations? Like, are there rules
for payday loans?
for payday loans, pawn shops? I think you've mentioned actually pawn shops are pretty tightly regulated and very standardized. I'm hoping it's to prevent people from just being exploited out of money when they're in a moment when they're like really desperate.
Yeah, I mean, definitely. I think that's why banks don't make small dollar short-term loans because they're not profitable for banks. So there are regulations for payday loans and pawn shops. It's all state by state. Like in our pawn shops, we were governed by the OCCC, the Office of Consumer Credit Compliance, something like that. And yeah, each state has their own regulations on how high rates can be, what types of collateral, stolen goods, all that stuff. It's heavily regulated.
I'm going to go out on a limb and say there's zero regulation for this in our digital world. You can correct me if I'm wrong on that, but like, do y'all take steps to make sure it's not a stolen Bored Ape, for example, that you're getting a loan against?
So everything's on the chain, right? So we can look at the chain and verify that it's the correct asset as part of the correct collection. If it is stolen, it'll show up. We do use KYT. So we don't do a KYC on the platform. We are a DeFi protocol, but we do know your transaction. So we scrub users' wallets that are on the platform to see if they've gone through a mixer or if they're blacklisted. But that's one way we filter the platform.
You mentioned Niftify and some of these other protocols and platforms earlier. It strikes me that the service offering is one that ultimately can be replicated many times. And I want to maybe stay short of calling it like a commodity or a commoditized type of service, but maybe it should go as far as that. How do you think about maintaining a competitive advantage and, doing this when there could be a ton that crop up, a ton of protocols?
Yeah, it's a good question. I mean, we build open source code. Anybody can fork our contracts and build their own backend UI, do the same thing we're doing. I think it's very hard to do that, especially with all the work that goes into the infrastructure that goes into building a DApp. But basically, our edge is our brand. So Arcade is a consumer application. We have a brand name around it. We have marketing. We do PR. Users are starting to trust that brand as sort of a category leader in NFT loans. So there's different things we can do also to sort of build a moat, one of which is providing utility to all the assets that are in our escrow. So like users still being able to access token gated discords or alpha chats, and also claim airdrops and anything that gets dropped to that NFT.
I'm obviously like presenting some of the skeptical cases here and some of the ways that all this stuff makes me nervous. But can you explain really on a macro level the importance of providing this kind of liquidity and how you think this feeds into just the broader ecosystem and the future of the digital ecosystem?
Yeah, I think that so today there's like 15 to 20 billion, probably less now because everything drops. So probably 10 to 15 billion of lendable NFTs that lenders are comfortable lending against. I think we at Arcade think of NFT as an underlying technology. It's at the end of the day, it's a token standard. And what can that token standard capture in value? Well, a lot of things online. It could be digital IP, it could be music, it could be ticketing, it could be digital land, financial NFTs like Uniswap LP tokens. So when you think of this online economy and the ownable internet, it's going to be massive. I think JP Morgan has a quote that's estimated like $1 trillion in yearly revenues for the metaverse economy. So when you think of NFTs as a technology that's capturing all of this digital native IP, a good portion of those assets will go towards loans. So it's really like a new asset class being developed. And that's why we're seeing lenders like Nexo and Genesis and everybody building a marketplace, because it truly is a new asset class that is starting to emerge.
And the importance of being able to inject liquidity into it like you can any sort of like IRL market, is that just you see it just kind of as an inevitability, so y'all will get there first? Is that sort of how you view it?
Yeah, I mean, I think it's a simple product. It's like stake your NFT and get a loan on it. But it's first mover advantage. You have protocols like Aave and Compound and Yearn that were really born in the last bear market. Well, they have brands that users trust now, and they don't, they're okay sticking money in their protocol. So if we get users and we show volume, we're also a non-anon team, so we're all docs, we're US based, which I don't think matters, but I think we're building a lot of goodwill with our community, and so continuing to build out features to enable access to liquidity is something that we're trying to do.
And you joke that you, in the bear market, feel a little bit more like a pawn shop, but realistically, probably still not a full, fully analog or whatever the phrase would be there. Do you see down the line that this truly will look like a pawn shop, and as well as servicing the high-end art lending market? Or do you think those two things decouple from each other? So again, if I have a few Oshus, I can get that 2% interest loan, and this will be exclusively a pawn shop. How do you see that play out?
Yeah, I think when the market matures and we see lower value assets come on chain, maybe gaming assets that are being minted on L2s or other chains like Solana that have lower transaction costs, I think we do start to see these lower value assets where people use loans as a way to get money out of the system and into real life. But right now, these high value NFTs are digital like luxury goods. I look at the collections as digital country clubs. So if you want to join the country club with like-minded people, you buy the NFT, and being able to leverage that asset for liquidity is important just because there's a lot of money tied up in these things. So it makes sense to be able to enable a lot of that liquidity to happen.
You mentioned your community. Do you have like a Discord? Like, have you set yourself up like any number of these protocols and all that, and y'all chat in a Discord somewhere, et cetera?
Yeah, that's one of our channels. We have a Discord. I think there's 4,000 members in it. We have Twitter. It was another one of our onboarding channels. Yeah, anybody can sign on to the app. So. And
what is their tie to y'all? Do you have a token? Are you like one of these who are like, we're going to move to being a decentralized protocol someday? Or why are folks hanging out in your Discord, I guess is the question.
They're trying to find lenders. They have questions about the app, the way the protocol works, support tickets, things like that. So just a way to educate the community and provide somewhere they can speak to other users of the protocol.
So no token at the moment for
no
Arcade.
Token, just product market fit.
Any plans for a token?
Possibly, but not right now.
What are you thinking about for the future, and have your plans changed since the bear market hit?
I think everybody has sort of had to readjust their strategy, their hiring needs. I think that conversations even from 2 weeks ago are widely different with like investors and in terms of roadmap. I think these protocols will now be focusing on revenue instead of generating a token that subsidizes usage. You're going to see protocols that really go after real retail usage and institutional usage without the need for a token to incentivize users.
Is this your way to like casually be like, we got that from the beginning, we were focused on revenue, or is that?
So I think we were always sort of thinking about the protocol as a way to monetize. Whether that monetization goes back to the community with a token is yet to be seen. But investors and really anybody building a protocol is going to have to focus on revenue, or they're just going to die out, or they're going to get acquired. Before the whole market turned around, I think the focus was on loan volume, growing users. But now the conversation is really about providing decentralized access to our protocol, but also monetizing it from a team perspective.
I'm assuming y'all monetize simply by taking a cut of these transactions that go on the platform. Are there other ways you're monetizing as well?
Right now, it's just the protocol takes an origination fee that's 50 bips, so 0.5% on the principal value.
You mentioned institutional folks coming in earlier, and I'm curious about institutional uses on your platform. But you also said something to me previously that I thought was interesting around institutions and maybe feeling more comfortable with this kind of a format than these like automated market makers we see in other DeFi protocols, because this is easier to KYC. You can, again, this peer-to-peer thing is easier than just like pools of liquidity. I don't know if I'm getting that exactly right, but I would love to hear you speak a little bit more on that.
Yeah, so you have protocols like Maple and TrueFi that work with institutional capital. I think on under collateralized loans, they do KYC because these institutions that provide capital, they're required from their compliance teams to do KYC.
Can you name, like, give some examples of like who would be institutions coming in here in this case?
So someone like a Genesis would do KYC. Someone like a BlockFi would do KYC. Someone like a BitGo. All these guys are heavily regulated, so they need to provide some assurances that the capital and the money they're lending out is not going to fund anything illicit.
Do you see like JP Morgan's getting into this, like truly like the mainstream, the most buttoned up, or feeling like they have to be the most buttoned up, getting into this space eventually?
Yeah, well, I think the ones that understand art lending are getting into it, are are looking at it. Like we were speaking to this fellow that was at Bank of America. He had a $10 billion book against fine art. So he worked with all the big collectors, and he was very interested in what we're doing from a perspective of one, data, but also making loans on like creative works.
Would he want to partner with y'all or buy you up, or is he just trying to figure it out so that he can go replicate a similar system at JP Morgan or at Bank of America?
I think they're just trying to figure out what's happening. Like they want to be able to be ready for when it does sort of hit mainstream and these banks can't ignore it anymore in terms of the infrastructure and the amount of money that's being settled on these smart contracts. So they're very interested from that perspective.
When you said they're interested about the data, say a little bit more about that.
Yeah, so like take Sotheby's, for example. They're one of the major art auction houses. They do auctions, but they also have a lending book that they themselves lend against this art. So being able to have the correct data in terms of how we price the assets, where it comes from, who's the creator, a lot of that stuff they don't have.
There is a brand new staking feature in the Ledger Live app today. We all like staking the assets that we're bullish on, and now you can stake 7 different coins inside the Ledger Live app. Cosmos, Polkadot, Tron, Algorand, Tezos, Solana, and of course Ethereum. With Ledger Live, you can take money from your bank account, buy your most bullish crypto asset, and stake that asset to its network, all inside the Ledger Live app. Through a partnership with Figment, Ledger also lets you choose which validator you want to stake your assets with. And Ledger is running its own validating nodes, offering a convenient way to participate in network validation, and it even comes with slashing insurance. Ledger Live is truly becoming the battle station for the bankless world, so go download Ledger Live. If you have a Ledger already, you probably already have it, and get started securely staking your crypto assets. If you're starting on your NFT journey, you need MetaMask. This is your tool to unlock the world of DeFi and NFTs without giving up custody over your private keys. MetaMask is both a secure in-browser wallet and also a secure bridge for your hardware wallet so that you can connect to any Web3 enabled website. You can now trade tokens with any DEX or aggregator. MetaMask Swap gathers real-time pricing information across the DeFi exchange ecosystem, allowing you to select your best price while getting all of the MetaMask benefits of self-custody, lower gas costs, and increased transaction success rates. MetaMask also has a fantastic mobile wallet, which I use while I'm out and about. And I use it to collect POAPs, NFTs, and use it for all my DeFi things while I'm away from home. If you haven't downloaded MetaMask, you gotta try it out. Download MetaMask for desktop and mobile at metamask.io, or load up your Ledger, Trezor, Keystone, or Lattice hardware wallets so that they too can get into Web3.
I want to talk broadly about where you're seeing Arcade go. One thing I know I've heard you mention in the past is becoming lenders yourselves and being sort of principal lenders. Is that still on your radar? Is something Arcade would like to do?
I think that's always going to be on our radar. A lot of our team has backgrounds in TradFi lending. Our CTO, John Terzis, was the first employee at BlockFi, actually. So he knows very well how they sort of bootstrapped early days of their lending marketplace. I think that we'll start to see more institutional capital coming in because this is a new asset class with a new source of yield that's a little bit somewhat uncorrelated from the rest of cryptos. It's kind of interesting. So I think as the universe of NFTs expand and NFTs start gobbling up a bunch of value, that a lot of these lenders will be interested.
Well, but you specifically, like, is Arcade interested in becoming like the person who's giving, not the person, but the entity that's giving these loans?
I think we were before this crash. We're not looking at it too close anymore, mainly because if we want to become principal lenders, we have to take out or we have to take on a debt facility ourselves. And so we have spoken to a few like credit funds that specifically lend to alternative asset classes, guys like us that want to lend out. But with the recent downturn and sort of everybody being risk on right now, tightening up their parameters, I don't think that's going to happen just yet. But we're always wanting to participate in our own marketplace.
Would it make sense at any point to have a component of this that's like an AMM, that's not peer-to-peer, but that is like a pool of liquidity that folks can draw from, or does that not map to this business model? Yeah,
definitely. I think you have projects like JPEG and BendDAO that are peer-to-pool. So they have a resting pool of liquidity that borrowers can come and just take right away instantly. We have a different approach that we built for our V2 protocol that allows for instant liquidity, but doesn't need oracles, pricing oracles, doesn't need auto liquidations. You can still work with our peer-to-peer model. And it basically allows lenders to sign bids across any collection on chain. So say I'm a lender and I go to Arcade Marketplace and I say, I want to lend 100 ETH against any punk or against any Basie. And so I sign that message, and then a borrower on the other side that has those assets can come and look at those bids and accept which one they want.
So what is on the horizon? Not thinking about becoming like loan originators for the time being. What's upcoming?
Yeah, so I can't reveal our entire strategy right now.
Why even bother coming on?
But definitely building out more loan features. We want to become the category leader, the premier place for NFT loans in a peer-to-peer fashion. So you can think of different extensions to that marketplace, which is maybe like a buy-sell market, different features like one-click buy and borrow, mortgaging an NFT, buy now, pay later. A lot of these financial primitives built into a buy-sell market.
Buy now, pay later is fascinating. Again, all of this stuff feels like it's adjacent to like things that feel like a little bit icky. You don't feel that?
I used to make payday loans, so I think that these are all finance games that happen in real life, and everything that happens in real life is going to happen on chain as well.
I get it. Like obviously, if folks need access to capital, you're providing them access to capital, and fundamentally, that's both people are agreeing to this. Both parties want this. So it is that it's great that we have folks giving payday loans. It's a tricky area. So I totally understand. I think I've heard you or your co-founder or folks in previous interviews talk about just expanding the pool of assets that folks can get loans off of, even insofar as maybe expanding out of the ETH ecosystem or expanding to like layer 2 assets or Solana or other chains, which I don't think you support right now.
Not yet. No.
Not yet. So love to understand when that might come in. And I think I heard somebody on your team say, it may have even been you, that some of it was pegged to like, are they offered on OpenSea? And we've now seen Solana NFTs on OpenSea. And I think Immutable X has announced they'll have their assets on OpenSea. What are you looking for to start integrating those assets, and when do you think that might be?
Yeah, I think we base demand based off lender appetite. So whatever lenders are willing to lend against, we'll support. It doesn't make sense to support every collection because deals are not going to get done. So we're only focusing on really the high value sort of long tail assets for right now. I think you have chains like Solana that are starting to really pick up in terms of being an NFT chain, because you have lower transaction costs, different capabilities. So even like I saw today, Magic Eden, I think the biggest marketplace on Solana, just raised like 130 million.
Yeah.
In this market, that's massive. And they're gaining traction, like real traction. I think, well, I don't know if it's all real traction or if it's any, bit of wash trading. I'm not sure, but Greylock invested in them just now. It's kind of interesting.
That is interesting. So Solana would be the first one you'd be looking at. No immediate timeline on that.
Solana, no, and it could be a scenario where we acquire maybe a team that has Solana experience because it's a completely different chain engineering. Also looking at L2s like Arbitrum and Polygon. I think we start to see, like when we're talking about GameFi and gaming assets, I think a lot of those will be issued on L2s. So being able to support those chains means lower value assets, means more transactions.
You mentioned the Magic Eden raise. Y'all closed your last round in December, January territory?
Yeah, at the Pico top.
I was gonna is that nerve-wracking? Are you like, our valuation is huge and now it's a bear market? How does that play out?
No, I mean, I don't think our valuation's public, but it wasn't crazy. We raised a seed round in April 2021 at a 15 million valuation. So it's much different than, pre-product, pre-revenue raising at 100 million valuation. So no, I think we're in a good spot. We have 22 full-time on the team. We've got good runway, an ambitious roadmap. So yeah.
So it feels good. It feels like, all right, we got money when it was easier to get money, but it didn't screw us in terms of
Yeah.
being too overhyped.
We maximized, I think, what we could have done, but we didn't shoot ourselves for the next round. So I think we're in a good spot.
You mentioned earlier sort of staying decentralized. Can you explain, obviously you don't have a token, you don't have sort of this like collective ownership piece per se. Where does the decentralization play in?
So the decentralization is in the smart contracts. So we don't take custody of the NFTs when they're in escrow.
It's the trustless piece.
Correct. Yeah. So when you're using the protocol, you don't have to trust. You can verify because it's on chain. So that's what's decentralized. The governance of the protocol and how it gets built is not as decentralized yet. That's why we see protocols like DYDX that move to a DAO model. But once they really have traction and a good product built, I think it's a lot harder to build products when you're in a DAO. It takes some level of leadership and top-down management at times to build really great products. So I think that's where centralized teams have an advantage over DAOs specifically. But we are building Web3. We're building community-owned protocols eventually. So I think we will look to decentralize the whole thing.
Does the community ask for that? Like, are you getting constantly told like when collective governance or whatever?
Not yet. No, I think our niche, our little sub-market is so nascent and new. People actually like that they know who the team is on the other side and they can talk to somebody and walk them through sort of using Web3 and smart contracts.
I want to close, though maybe additional questions will come up, with a little bit of the pawn shop experience. What do you feel like you most learned from that you've taken into your role now?
Ooh, that's a good one. I think I learned a lot. So I was working closely with my dad right after college for 6 years in the pawn shops. My grandpa started one of the first pawn shops in Texas in 1947. So I was a third generation pawnbroker. I spent a lot of time behind the desk working, making loans on diamonds, on Rolexes, on purses, Xboxes, PlayStations, kind of everything under the sun that didn't eat. We didn't take things that didn't eat. I mean, that did eat. We don't. It's expensive to feed live things.
Wait, so that's like a thing?
We don't take that.
Okay, I know, but that's a thing that you have to specify that because people will come in with like pets.
I'm sure somebody has pawned a chicken before or something like that. But not us.
Okay. If you could eat it or it could eat you, that was a hard rule. Got it.
Right. And like usually in the pawn shop, you say if somebody bought it once, somebody will buy it again. That's not true in NFTs.
Oh, interesting.
Yeah. So
that makes sense.
So yeah, and also just about consumer habits. I spent 6 years making small dollar short-term loans against cars, against pretty much, anything that somebody else would buy in the event of a default. So
I think that's really interesting that if somebody bought it before, they'd buy it again because you're talking about super mature, established markets, right? Where it's a diamond and that's been worth something for X number of centuries at this point. So, there's always going to be a market for diamonds. And at this point, Xbox, probably same deal until gaming consoles become in our eyeglasses or whatever. How long do you think it takes for the digital asset market to mature to the point where that's true in this market and the digital market as well as it is in the physical one?
I think we're 3 to 5 years off from
That's not that long.
Right. I think it's going to happen fast. The idea of scarce digital money is like Bitcoin and Ethereum. The idea of scarce digital goods and collectibles. I think if you can understand digitized scarce money, you can understand digital scarce collectibles also.
Did you loan against art at the pawn shop, or that's again reserved for highbrow something or other? I don't know.
Yeah, I mean, there's like high class pawn shops that lend against like Academy Awards or like a Golden Globe or $25,000 purses or 5-carat diamonds that are worth 10 million. We did some art pieces, like we did an old newspaper from like, I think Abraham Lincoln days, but like vintage items like that are provably scarce.
And in that scenario, so you're out there up front on the cash register, like you're having to determine a price and evaluation for something like on site. Is it just you? Like you don't have your team of data scientists, experts in the back calculating it based on like historical average? Like how do you do that?
Well, I mean, like eBay helps, Amazon helps. You can price anything just by looking at it on the internet, see what it's going for.
And is that what you're doing? They bring it in and you're like pulling things up on the computer at the cash register being like, wow.
Pretty much, yeah. You start to see the same things come into the pawn shop, and you know what to lend. You know what to lend against. But yeah.
Are your parents still, or is your dad still in the pawn shop business?
So we sold the business. It got acquired by a larger chain in 2016.
Is he like excited about what you're doing? Is he like?
Oh, he's ecstatic. Yeah,
he's like, you're continuing the family legacy in the new modern era.
Exactly. He's like, let me be. I want to be an advisor. I know this space. Like, I'm a pawnbroker. He also wants me to talk to all the pawn shops because he thinks that's very relevant because we're up the pawn protocol. I don't think it's not relevant yet. I think there's some things we can do with like tokenizing notes, loan notes, getting that on chain, but it's very, very different.
Explain that.
Like say a pawn shop, so a pawn shop makes loans and they have a pawn note that they get in return that the borrower signs. So maybe you can imagine a world where loan notes get tokenized to allow anyone in the world to invest in pawn loans.
Oh, wow. So you're no longer limited by geography.
Right.
You can actually just say
or by needing a pawn license.
So I could just say, I'm looking to pawn this thing and I'm trying to summarize this.
Yeah, it's not well thought out, but just...
Like I could put an image, I'm trying to figure out how you verify it, right? But in theory, you would get it verified in person at a physical store that does have a geolocation, but it could be open to anyone globally who could then loan against it.
Right.
Pawn shops themselves, though, that's not peer-to-peer, right? The pawn shop itself has a store of cash that it's loaning at.
Pawn
it
shops
is originating the loan.
Peer-to-pool, yeah.
Peer-to-pool, correct, right? So the pawn shop itself has the pool, which is what y'all don't do. Well, this is fascinating. Is there anything I've missed that I need to better understand or the audience needs to better understand about Arcade and or like this market generally, its place in this whole macro picture?
No, I think we touched on a lot. I think that the very interesting thing here to me is that we have institutional capital that are using Web3 rails right now, but
that institutional capital is very Web3. Like Gemini is a product of Web3. BlockFi is a product of Web3. So are you talking about them, or are you talking about your Bank of Americas?
Like take 3AC blowing up last week, for example. So 3AC borrows money from all the other marketplaces and market makers and desks. So they borrow from BlockFi, they borrow from BitGo, Nexo. I don't know if those guys are taking collateral when they lend that money out.
They're clearly wildly under collateralized.
Right, but we don't even know.
Sure.
And so they're signing term sheets in the back room that it's not transparent, the market doesn't know about. So that's like the beauty and proves the use case of smart contracts and DeFi is that the blockchain is literally the term sheet. Yes. It's all out there. It's transparent.
So I of course agree. It's like CeFi. It's centralized finance. Exactly. The fact that Celsius can freeze withdrawals is not Web3 in the sense of decentralized, trustless, permissionless. Like it's trustful and they were a bad bet to trust, as it turns out. Right. That's what you mean. Yes. Okay. So institutions in the sense that it's like centralized players, even though they're sort of born out of crypto.
Right. Because most of DeFi in the last few years has been retail money, degenerates that are using protocols that haven't been audited. But I think we're starting to see a real use case for using Web3 rails with like non-native crypto capital coming in also.
My final question is about the name Arcade. How did you come up with this? Why did you name it Arcade?
Yeah, so we changed the name. We were originally pawn.fi. So we bought that domain in like 2020, wanted to tie it to the pawn shop. So obviously I named it pawn.fi. But there was like 2 or 3 other PawnFi's protocols that popped up, I think, that had raised money or did a token sale. So we knew we had to differentiate. And my co-founder, Rob Masiello, is actually the one that came up with the name Arcade. At at the time, we had built a minting contract that we were calling internally Liquid Mint that was on a bonding curve. And so Rob was thinking, if we had this minting contract and we had a marketplace, maybe a good name would be Arcade because of the arc representing the bonding curve. So we didn't end up even using, or we haven't used that contract yet. But when you think about Arcade and you think about putting a token into a machine, it really makes sense to have it be a crypto marketplace.
Yes, okay. So I thought it was like a little bit gamified, a little bit getting into like,
yeah,
it's all a game.
I think the name pawn.fi limited us to just like loans and a lot of our investors, when we were pitching the idea, was like, why is the name pawn? That's like a negative connotation.
Yeah.
And I was personally offended. But so we ended up changing it. I think it was good feedback on the name change. But yeah, all credit to my co-founder on that one.
Awesome. Well, thank you so much, Gabe, for joining me. Always fun to do an in-person interview. So I really appreciate you coming by. And I am fascinated by how all these financial primitives will play out in this space, for better and for worse. Again, a lot of it makes me nervous, but I also understand a lot of it provides tremendous value to people. So it's a mixed bag, but really, really grateful to you.
Yeah. Thanks for having me on and hearing me out and asking good questions. So.
Thank you so much for watching this episode of Overpriced JPEGs. If you liked this conversation, if you liked this episode, please go ahead and hit subscribe. It helps me out, it helps the show out, and it means you will get alerts and updates when we post new content. Thanks again.